You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz, and it's 3/30/21. Well, did you wonder what it was like, what really happened during the 08-09 financial meltdown? Do you want to get an insider's perspective of what the government was really up to and what the big banks were really up to? What was their game? Well, you're going to get it today. Really fortunate to have Kerry and Linda Killinger with us. And Kerry, you were the former chairman, president, and CEO of Washington Mutual Bank, which was the sixth largest depository bank in the country prior to the financial crisis of 08, and then became part of JP Morgan Chase. And Linda, CEO of Olympic Consulting Partners. You have an MBA and both been involved in the financial sector for most of your professional lives. We're really thrilled to have you. So, Kerry, it's not every day I meet somebody who's actually a little older than me, who has my first name, but welcome to the show. Hey, you built up, just tell us your background with Washington Mutual and how you built up the bank.
Well, thanks, Kerry, and it's a pleasure for Linda and I to be here today and talk some things through. My background very quickly, I came out of the Midwest, grew up in Iowa. In fact, my wife and I were born in the same hospital, same doctor in the same year, but it took us about 50 years later before we actually met. So we're fortunately been together now for about 20 years. But professionally, I came out of Iowa, undergrad and graduate degree from the University of Iowa, and then worked for an insurance company in investments. Got to know Warren Buffett back in about 1970. So I was always kind of a value-oriented investor and ran an insurance company's investment portfolio and then on to manage a whole group of mutual funds. And we grew those companies out in Spokane, Washington, very successfully, and got the idea that teaming up with a bank would be a pretty cool idea for the long term. And we merged that company with Washington Mutual back in the early 80s, became the first bank in the country to have a full complex of mutual funds, broker dealers, a bunch of diversified kind of businesses that really worked out. The only problem is Washington Mutual was losing a ton of money then and was a small little thrift with about $2.5–3 billion of assets. And they asked us to get involved in a major turnaround of them. And sure enough, we just put down some tough management and got the costs down, got them converted to a publicly held company from a mutual ownership, raised capital. And long story short, we grew a company from $3 billion in assets to about $350 billion in assets. And we were regularly earning about $4 billion a year and got all kinds of recognitions of being the top consumer bank in the country for customer service and all those kinds of things. And we're adding about 1 million new customers a year when the financial crisis hit. I'll just say one thing leading up to that financial crisis. We all saw that housing was getting overinflated. And I was serving on a council with the Federal Reserve, Warren Bernanke and others there, that housing was getting into a bubble status and we needed to watch it very carefully. He said, "You guys don't know what you're talking about. Our economists say housing is not a problem." We said, "Hey, dude, you do what you want to do. We're going to cut our lending." And we cut our residential lending by 74% for the 3 years or 4 years leading up to the financial crisis and got out of the higher risk things like subprime. And we raised a bunch of capital. So going into the crisis, we had the highest capital ratio. Our loan losses were much less than the industry. And we'd really cut out the more risky lending for the last several years. So we thought we were really well positioned. But man, we got caught in the middle of a political buzzsaw when the real too big to fail banks, and we called them too clubby to fail banks, were able to do an assault on us and take us over.
Hey, and it all is summed up in your book, which is Nothing is Too Big to Fail, how the last financial crisis really passed its prologue, right? The previous crisis is always what sets up the next crisis, and so on throughout history. So you built up this bank. It was really profitable. You didn't even have much subprime lending. You'd cut back on that. I mean, it was almost in single digits. And yet other banks were far more exposed and survived, and yet you didn't. So obviously a decision was made from up high that there was no need for Washington Mutual. Linda, like you're watching all this unfold kind of through Kerry's eyes. What was going through your mind at the time?
Well, it just seemed like there are a lot of the same issues that were going on in the 1980s crisis. During the 1980s banking crisis, I was partner in an international accounting firm, and the regulators would send me in to build 5-year plans for the banks that were failing in the 80s. And the whole system was treated so differently than what was happening in 2008. And Kerry really thought he had protected himself. He's probably one of the few Fortune 50 CEOs who have taken a major product, a very major product, a home lending, and dropped it by 74%, and then replaced it with new products and services, and continued to have record growth and a revenue.
Yeah. So was this a big plan actually, or was it an opportunistic taking by the so-called too big to fails, also called too big to jail? These banks, was this just an opportunistic way to bump off a whole bunch of unwanted competition, consolidate the industry? Because we saw many, many banks cease to exist during this crisis. And now the 5 majors or 6, you see them on every block in every major city, every town, in every state. Really, we supposedly had learned all these lessons during the Great Depression, right?
Don't just survive, thrive. The Financial Survival Network.
Lumina Gold, ticker symbol LUM on the Toronto Venture and LMGDF on the OTC, is yet another of legendary mining investor Ross Beaty's Lumina Group. It's advancing the largest primary gold deposit in Ecuador. The resource is estimated to contain 16.7 million ounces of gold and 2.2 billion pounds of copper. At just $7 US per ounce gold equivalent, it trades at an incredible 13% of its net present value. More good news is on the way with an updated PEA study expected in Q2 of 2020. It has unparalleled infrastructure. There's grid power to camp with plentiful, inexpensive hydropower available. It's close to 2 ports and is just 8 kilometers from a paved highway. Water is plentiful. It's at low elevation, and the closest community, which is very supportive of Lumina's effort, is just a 7-kilometer ride. With all this going for it, it's likely to follow the typical Ross Beaty formula, which means big returns to shareholders. Find out more and sign up for notifications at luminagold.com. That's Lumina, Lumina gold.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Supposedly, but in March of 2008, when there were banks collapsing all over the place and all the other banks had record low income and were really struggling for capital liquidity, in March of that year, Hank Paulson, the Treasury Department, released a report that basically said everything's okay. We have a great financial system. He didn't mention anything about Bear Stearns was collapsing the week that he issued his report, and there was no mention of that, no mention of any problems with the investment banks. But he did have one recommendation in his blueprint for a modern financial system, and that was to eliminate all the thrifts within 2 years.
Yeah.
So he had a plan, and then you add the FDIC, which is the other part of the Bermuda Triangle. And they, after IndyMac failed, Sheila Bair, who was chair of the FDIC, was literally in panic mode. She knew that if any other bank that size or more collapsed, that it might take away her deposit fund. And so that was her major concern, was a deposit fund. And then the third part of the Bermuda Triangle is Jamie Dimon and JP Morgan Chase had made it known to a lot of people that he wanted to figure out a way to get Washington Mutual for pennies on the dollar. So he was working behind the scenes to try to make that happen. And we did a lot of thorough investigations, read a lot of reports, and our book almost reads like a John Grisham novel in our trying to piece together what exactly was going on. But, Jamie's plan, and this is documented by the bankruptcy examiner, what he wanted to do is he really didn't want to buy Washington Mutual because he'd have to get shareholder approval. It would take a long time. He wouldn't get to pick the assets or leave assets that he wanted to leave. And so he would have to mark the assets to market, which he didn't want to do. So he had a plan, and he started putting together presentation decks. And according to the bankruptcy examiner, JP Morgan Chase started putting together presentation decks, trying to encourage the FDIC to seize the bank, seize Washington Mutual, and turn its assets over to JP Morgan Chase. And so they worked on this, according to the bankruptcy examiner, all summer and into the spring, into the fall.
Wow. And eventually the plan was successful, wasn't it?
It was very successful. It was brilliant.
So you use government power, regulators, everything else to put your competitor into a precarious position, and probably released a lot of bad PR about the bank as well. And then you move in for the kill when you have regulators panicking, oh no, we can't handle another. But didn't JP Morgan Chase wind up putting in tens of billions of dollars more into what was left of Washington Mutual for, not quite sure what purposes? I saw a number of 31 billion more they wound up investing in the bank.
Well, they put more capital into it because they had to mark to market assets, which when you're in a crisis, you have a very temporary depression of some of the prices. And yes, so they put up some capital to support those, but then they're able to reverse all of that into, and then way more than that, back into profits over the next several years. So what happened, I think certainly from what he said publicly in his shareholder meetings, that was just an outstanding acquisition. They just got it for pennies on the dollar, so to speak, and became just a real financial boom for him in the following years. And so I think, again, he did a great thing for his shareholders, and I understand that. But he also did certainly the way the Treasury acted and the way the FDIC panicked and the way they went along with entering what should have been a private transaction with government officials pushing the way on things, I think just created a lot of shareholder value for them and destroyed shareholder value for Washington Mutual.
Yeah, it was literally a fire sale. I think I saw 1.9 billion. Again, yeah. The book that is written by the Killingers jointly is Nothing is Too Big to Fail. And maybe we're getting to that point this time. I know banks look better on paper, but it seems like the banking industry that I know, certainly the international banking industry, the global industry, their main pursuit is looking for new ways to lose money and wind up needing bailouts. This is, it was international lending way back when. They'd come up with these exotic products, credit cards, consumer lending. They figured out how to lose money on that. And now everything looks good. But I just wonder, Kerry, if there's actually stuff lurking on their balance sheets or off their balance sheets, special purpose vehicles, et cetera, that are going to lead to the next financial crisis.
Well, I think we're definitely concerned that the seeds are being sown for the next financial crisis. We think the party that is most responsible for creating risk for the next financial crisis, the Federal Reserve. They have been pumping the system with so much money for so long now, over a decade of growing the money supply much faster than the economy, with keeping interest rates below the rate of inflation. When you have negative real interest rates, unintended consequences often take place, and then acting as a backstop for guaranteeing a bunch of mortgages and loans and small business loans now and municipal debt and things they did during the COVID-19 issues last year. And the net result of that, there is so much money chasing very few assets around the world, prices are going crazy. So we're seeing bubbles categories in stocks. We're seeing bubbles in lots of real estate, particularly homes in some high growth markets, not just here, but all over the world, because other central banks have followed the same lead of our Fed and are creating these conditions that cause asset prices to go up. Well, if you're a bank or anybody else lending against those assets, it looks really good right now. But if those asset values plummet for whatever reason, that's what can put you into a major downturn and potentially a crisis.
Yeah, I couldn't agree with you more. The seeds are being sown for a crisis far worse than the last two. Kerry, finally, did you ever meet with Jamie Dimon at some point while this was happening or after, and actually get him in an unguarded moment?
Well, look, I know Jamie. We've known him for years, and so we worked on industry things together. We had meetings, and we talked about the benefits of potentially putting the networks, the franchises together when the time was right. And I was always open to doing those things in a way that would benefit our shareholders. What I couldn't control, as it turns out, was the kind of behind the scenes maneuvering that went on with the FDIC, with Treasury, what we called the too clubby to fail group that got together and made all the decisions of who was going to win and who was going to lose. And guess what? Wall Street won big time. Community banks and thrifts lost. They got pretty much merged out or were forced into secondary positions. And you ended up with things like a huge transfer of value, in our opinion, from Washington Mutual shareholders over to JP Morgan Chase's.
Yeah. And that is inherently unfair, and the system isn't supposed to work that way. Again, the name of the book is Nothing is Too Big to Fail. Nothing is Too Big to Fail, How the Last Financial Crisis Informs Today. And it's available on Amazon and wherever fine books used to be sold. And hey, we wish you the best of luck on the book. It's, I guess, just released last week. And hopefully we can learn from the past. But, there's an old saying, the one thing we learn from history is that we don't learn from history.
Yes, that's true. Thank you for letting us on your show. The book has been doing really well. Last week, right after it was released, we got the Axiom Award for one of the best business books of the year. Well
deserved, I might add. And just the insider's peek, the nose under the tent, to really see what was going on and how this all transpired. You've done a real service. Really appreciate you coming on. Any questions for the Killingers? Just send me an email to kl@kerrylutz.com. I'll forward it off to them. And while you're at it, go over to financialsurvivalnetwork.com. Sign up for our free newsletter. Hey, really appreciate it. Kerry, Linda, thanks for coming on, and great luck with the book.
Thanks, Kerry.
Thanks so much, Kerry.
We appreciate it.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.